The final piece of this macro overview talks about the impact of policy. Around the world, we have different countries, different political structures, different cultures. So these are actions that government takes, not just for financial purposes, but to achieve social ends. So we start with policy outcome. These are actually done by agencies in pursuit of making decisions and statements and trying to push something forward. Then there's the outcomes. Output and results are two different things. The consequence for society overall is that sometimes these are very short-term focused, and they're attempted to influence GDP, unemployment. And oftentimes there's unintended consequences of policy action that are not intended, but they happen. And sometimes it's by action, sometimes it's by inaction. So what we have is this policy impact is both in output and has outcomes. It's the things that they are doing and the results of what they're doing. Now, for successful policy, addressing the growth in the economy and low unemployment are good things. Let's keep going on this topic as we look from a financial perspective. We have the government policy, and that has a fiscal component, which is spending and tax. So there's revenue and expenses. Then there's monetary policy, interest rates, money supply. In the U.S., the monetary is the Federal Reserve, which we will talk about shortly. And this is the federal government, ranging from the executive branch to the congressional branch, the legislative branch, to the judiciary. So we want to think of policies as coming through this. So policy can be achieved by taxing, spending, and monetary policy through interest rates and money supply. As we keep going, we're going to take a look at some of the key areas. There's so many of them to look at. We're going to take a look at trade, tax policy, healthcare, interest rates, oil, and there are so many others that go along with that we're just going to hit some of the high points. Let's start with tax policy. Well, there are two aspects. One, generate revenue for the government to pay for expenses and projects. So there's to generate revenue. So that's what taxes are trying to do, pay for expenses or projects. But it also is to encourage a certain set of behaviors. They want people to behave a certain way, and if you create a tax structure, you can incent that behavior. So you want to get consumers and businesses to use taxes to cause an outcome. And I think that's important as we think about it, that there's a purpose behind this. The biggest thing that happened with the 2017 tax cut, there was some personal stuff, but the biggest impact that's relevant to us today is you went from a tax rate on corporations from a high of 35 million down to a flat rate of 21. So this is really a huge jump. Now, the intent of this, one, there was twofold. One, to make it a more competitive with other countries around the world, but importantly to incent companies to make an investment in their future. Now, the majority of these savings went to dividends, buyback, executive compensation, as opposed to investment. The general thought was people were going to spend this money to hire people, build new plants, do more R&D, and we haven't seen that. And I think that's because companies are operating within those broad themes that we talked about. So if you can't build a new plant if you don't have enough workers, or there's not enough consumers for that demand, income isn't high enough. So that sort of was, it benefited an awful lot of people. It caused the financial markets to move up, but it ended up redeploying capital to different parts. When we look at this, what we look at this in billions of dollars is that when we look at the tax cuts over the next 10 years, what we see is that we're going to have a total of lose about trillion dollars in revenue. So this is revenue that the country would have taken in based on the old tax rate. You can see the majority of that is business. The personal is primarily by those in the top income brackets. Then there are possible revenue raisers. They repealed the personal exemptions, itemized deductions, so that'll bring in about $4 trillion in revenue. So the combined cost of this is $3.5 trillion. So that tax bill, we said, cost $3.5 trillion. So now the government either has to borrow that money, and if they borrow that money, they're going to have more interest expense, which is going to burden future generations. That's you. Okay? So this was a very costly thing to do, and the hope was that it would generate this number here. The expectation was this would be way up here, and it isn't happening. We haven't seen it. It's not likely anymore. When we see what happened with debt, the federal debt, we can see 3 tax cuts, 81, 2001, 2017, as a percent of gross domestic product. So what we're seeing today is the tax cut were significant, no doubt, but as a percentage, the debt as a percentage of the GDP has grown exponentially. Now we're up to 76.7% of gross domestic product. That's a huge number. When we look at going forward, we can see the sugar high, and that's in 2018 where we have spending. But when we get into 19, the effect of the overall incremental impact of the tax cut goes to almost nil. And that has been the historical pattern in the past, as it's moved after the tax cut over time leads to slowing growth. Let's talk about trade. Well, exchange. First was the exchange and the value of one currency compared to the other. Some are market driven, willing buyer, willing seller. Other are pegged to a currency. From a U.S. perspective, the higher value of the dollar means imports are cheaper for Americans and exports from America are more expensive for other countries. So the dollar is fairly strong today and expect it to remain strong. So if you think about this as we lead into trade, if our dollar can buy more, that would entice us to bring more imports into the country. But be able to export them with higher values, there may not be the value. So it's trying to find that right base between them. So that's the first aspect of trade, the value of the dollar. Then there are trade agreements, and those between countries, and it defines what can be traded and what taxes or tariffs are added is an unknown. A tariff is a tax. Okay. Some people don't like the word tax because it sounds better as a tariff. The major risk that we have as a global society today is a trade war, with each country taxing everything, plus, minus, imports, export, but who pays for it? I think as we get into this, you're going to see very clearly what that is. So a tariff is a tax paid on goods entering a country from another country. It's oftentimes a percentage of the value, and the goal is to equalize costs between the two countries. But remember, production moved out of the U.S. to lower cost of production areas to reduce the price of the product so people can afford it. A trade war happens when one country places tariffs on goods from one country and that country retaliates. No one wins. Everybody gets hurt. Okay? But who pays them? They're paid when they enter the country by the importer and thus get passed along to you, the consumer. The theory is instead of importing products at a lower cost, you produce the product in the taxing country on the basis that it will create jobs which will offset the higher cost. Is that true? Well, when we take a look at what we import and what we export, when you look at different categories, we import primarily, the excess is our consumer goods. except food and automotive. The others at times were net negative. So when we look at it, it's not that huge compared to the GDP as a. What we're going to take a look at next is a little discussion on tariffs.
Pays for the higher tariffs on Chinese imports. Here's what President Trump had to say this week.
Our country can take in $120 billion a year in tariffs, paid for mostly by China, by the way, not by us. A lot of people try and steer it in a different direction. It's really paid, ultimately it's paid for largely by China.
But Larry, that isn't true. It's not China that pays tariffs. It's the American importers, the American companies that pay what in effect is a tax increase and oftentimes passes it on to U.S. consumers.
Fair enough. In fact, both sides will pay. Both sides will pay in these things. And of course, it depends.
If it's a tariff on goods coming into the country, the Chinese aren't paying.
No, but the Chinese will suffer GDP losses and so forth with respect to a diminishing export market and goods that they may need for their own.
I understand that, but the president says China doesn't. China, it pays the tariffs. They may suffer consequences, but it's U.S. businesses and U.S. consumers who pay, correct?
Yes, to some extent. I don't disagree with that. Again, both sides will suffer on this. Look,
well, I want to pick up on both sides because let's look at one study that projects what the costs are of all U.S. tariffs. Look at the screen. This study found that all current tariffs cost an average family of four $767 a year and cut U.S. employment by more than 900,000 jobs. And the study found if the president were to impose that 25% tariff extended on all Chinese imports, including the $300 billion, plus the cost of Chinese retaliation, it'll cost an American family of four $2,200 a year, cut American employment by over 2 million jobs, and cut GDP growth by more than 1%.
I'd like to take a look at health care in general, but let's just talk about the Affordable Care Act. When it was enacted, the intent was to move to more a prevention and lower cost-based model instead of an emergency acute cost. So the view was that at a lower cost you'd have better outcomes. Now, a hospital has to treat you irrespective of your ability to pay. So let's assume that you have no insurance, so you're not, if you have diabetes, you're not managing your diabetes. You end up in an emergency room and they have to treat you irrespective of your ability to pay. So they do that, and that becomes a loss to the hospital, which goes into the reimbursement rates. Now, when you go to a hospital, that's the most expensive form of treatment that you can get. In an agency that I am part of, if you come into our walk-in clinic for an evaluation on chemical dependency, we get paid about $300. Really cost us $500. But if you go to the emergency room, that same service is going to cost $2,800. And we actually have better outcomes. Now, part of the key parts of the Affordable Care Act that I think are important to talk about from your perspective is their standardized definition of coverage. It includes behavioral health and chemical dependency. Before, every policy was different. Adult children are covered till 26. That's you. If we didn't have it, you wouldn't have insurance. You can't be denied coverage because of pre-existing conditions. The current policy, this is where the policy comes in, is to eliminate this completely, all these coverages, and implement something better. We don't know what that is. But let's take a look at healthcare. 10% of the population is really affected by that. As you can see, 46% are covered by employers, 18% under Medicare, which is for seniors, 16% under Medicaid, and this is the Obamacare, and we still have 8% of the population, another 30 million, who do not have insurance. So we're talking about 60 million people. But a lot of times the policy is around Medicaid and Medicare, so that if we can reduce reimbursements around here, that will reduce the cost of health care. So this is just who is going to be impacted by it. Now, And the good news, if you look here at this chart, you can see that we spend in the USA, we spend $10,348 on average per person. We spend more than any other country in the world. Look at this. When we look at all the developed countries, the comparable countries, the developed countries, spend about 5 and we spend 10. So clearly, we must have the best healthcare system in the world. Well, let's see. Well, these are outcomes. Okay? So we spend more and we get less. Look at the lifespan at birth, 2013. US 78, below every developed country. Infant mortality per 1,000 live births, 6.1 in the US, 3.5. And if we look further in this, most of these mortalities happen with ethnic minorities, these are with low-income individuals. Percentage of the population with 2 or more chronic conditions. Look, nobody's even close to us. Obesity rate, 35.3% of the population is obese. Look at these. We don't have that. The only one that we're good at is we don't have daily smokers. Percentage of population over 65. Again, we're below average. We could keep going with these, but in the bottom line is we spend more for healthcare with less outcomes. That is a policy. How that's addressed from a policy perspective will impact many things in the future. Let's look at another piece of this is opiate use. If you look at 6% of the U.S. population uses opiates, okay? But when we look at some of the other developed countries, we don't see that high of a usage. So, I mean, that stands out. We're different. We spend money on healthcare, but yet we still have this opiate use. This one is, again, a scary thing. We look at different countries, and then we look at people ages 45 to 54, and we have seen the death rate in white Americans go up 3.4. Hispanic Americans down 31. When we look at France, down 31. We look at Germany, down. Every other country's death rate is declining except for white.